Welcome on board Sandip Agarwal as well from Sowilo Investment and find out what he's making of the market right now. Sandeep, hi, good to have you on the show and can't help but notice the rebound in IT, coinciding, of course, with the rupee weakness, but does it seem like it could be long-lasting this time?
Hey, hi, good afternoon, and thanks for having me on the show. So, if you see, last 1 month, I have turned very positive on the sector, and I have come on your channel also and said, and the reason is very simple. One, the correction which has happened in last 15, 16 months is very, very sharp and good. So basically, the PEG ratios which were at 5, 6 times are now at 1.5, 1.6 times. Second, I think the rupee depreciation, which is 13%, that is massively underestimated as of now in the estimates, because what I see is that there are some upgrades in earnings, but which are limited to 2-3%, because in the past few years, whenever rupee has depreciated, the benefits have not flown into the margins. But I would like to highlight the fact that it has not flown into the margins in past because of two things. One, all the companies always had a bigger bench. They wanted to invest in bench whenever there was a rupee tailwind. Second, there was a lot of money which went into the localization, increasing the local workforce, and which was like below 30% went up to 65-70% for most of the companies. So that ate away almost 5 years of rupee depreciation benefit. Now all those targets have been achieved. So I don't see now there is any scope for any of the Indian IT companies to invest in any of this stuff which is required for their business momentum. So I think the EPS flow will be direct to the rupee depreciation will directly flow to the EPS upgrade. In my view, a 15 to 20% EPS growth for next 2 years is given for the sector. And I think from that perspective, 1.5 time PEG ratio for large names looks very, very reasonable.
Okay. Sandeep, what to expect of the Q4 numbers? Give us a sense of that, because obviously the commentary will be the most interesting part of it, but currency depreciation will likely reflect on the numbers as well. How should one look at the numbers? One, how are you going to look at it? And second is what to make of the commentary, because that's going to be the more interesting part.
So if you see, Indian IT has always been a first half growth story, except for Wipro, because they used to have a lot of Middle Eastern Indian business, where second half used to be strong. But otherwise, third quarter due to manufacturing furloughs, and fourth quarter due to less number of working days in February, has always been a muted quarter. So I don't see anything different this time. But I do firmly believe that there is no major disruption in revenue growth which will happen immediately for the Indian IT services company. So that is number one. Number two, the rupee depreciation which has happened. So obviously, it will reflect in the rupee INR numbers. But as soon as you go to the other income level, a lot of what you make at the EBIT level goes away because of the losses which you have to book on the hedges. Having said so, but you have to remember that now everything gets repriced for next 6-12 months at the current currency exchange rate. And when you do that, then, broad mathematics is like, every 1% depreciation in rupee gives you 1% additional EPS growth. So we are talking about 13% EPS growth alone from the rupee depreciation. And plus, let's assume we do 5-6% rupee revenue growth for next 2 years. So even the large caps will see 27-28% of earnings growth over next 2 years in the worst case scenario, which is like 14% CAGR. And multiples are also like 14-15 times only. So I think it is a strong case for re-rating and some quick upside of 30-40% in the sector. Obviously, it may not work. It may not turn out to be true. If rupee goes back to 87, 86 level, then obviously all this, what we are thinking, may not turn out to be true.
Okay, and Sandeep, are you positive with regard to the lending basket, and what within lenders interests you the most? Some really strong numbers came out, and of course there were some weak ones as well, but predominantly very, very strong in terms of the lending growth that we've seen.
Yeah, so we are in a situation where there is obviously a little bit of confusion. First of all, to start with the RBI, how RBI will react. There, I think, RBI will choose growth over inflation. It is what my view is, because they need to cool down the bond yields as well. So they need to be more balanced because people will read from it. So when that happens, and if for example, today what market is building in is that, there could be a hike in this year. And if there is a hike, then what happens is that, you obviously shift more towards the banks, big banks again, because that is where the margin of safety is higher relatively. So I think, as of today, PSU banks and large private banks, because they have corrected quite sharply, looks good. But if, let's say, this war persists a little longer, then I think automatically there'll be more preference for the large private banks because they have corrected much more sharply. They have massively underperformed relatively. So we are also looking at private banks very closely, and I think there is a lot of value in some of the names. So yeah, means depending on how this war prolongs, where does the crude goes and all those things, we will have to take our call. But I think the private banks do offer great value if you're looking from a 2-3 year perspective.
Right. Okay, that's the take coming in on what the internals for the entire financial pack. Deep, where is it that you're finding comfort, if at all, within the entire EMS pack? Would you be recommending buying any?
See, we were looking very keenly towards the AC makers, but AC component and all those makers. But the problem is that, as rightly mentioned, that there are some drizzling happening in some parts of the country. So summer may be a late summer, and generally air conditioner and all, you are very time sensitive products. So if you don't buy for a month or 2 months, then so buying them or selling them becomes very tough. So that is one area where we were very keenly watching, but now I think may not be the right time to look at them. And secondly, within the EMS space, again, because of all this global supply chain disruption, I think whatever we have expected as a sharp recovery may not happen everything immediately. See, March numbers may look good because what is happening is that only 1.5 month, 2 month disruption is there, but it is not a complete disruption because everyone also did had some inventory levels. The right number to look at will be June. So either when the March earnings call happen and the management guides what they're seeing into in that quarter, then only you will be able to make a case. So I think March numbers broadly, everyone will have good numbers. The real challenge and real test will be the June numbers, because that is where you will see maximum impact. So we will be on a wait and watch mode in these all sectors. We will be more tracking the domestic ones where there is deep value, the capital goods industry, the play on the Middle East post the war. Because see, post war we think there will be massive capex cycle again, which will start in Middle East. So the large capital goods company, the small and mid-sized capital goods company, which are big suppliers to Middle East, even some of the ancillaries, they will do phenomenally well. Now, when the war ends and when that starts, there could be 3 months, 6 months, we don't know. But that looks like a structural theme again for us next few years.
Very interesting, Sandeep, you bring that out. What about defense? Will defense also continue to see enough tailwind? And how do valuations look versus the kind of tailwind that you likely expect to see?
So, last 4 or 5 years, people have realized that you need to be to build your own defense capabilities. And I think if you see India's defense export numbers, you will realize that we have done phenomenally well on that front. And that is also because of the awareness which is there for own defense, building up defense capabilities by smaller countries and the countries which are not directly into the making of it. So I think, defense will do phenomenally well for next 5-10 years. It is a structural theme. Only challenge is that, the prices at which defense stocks are available are insane and very tough to justify. And that is the key reason that, we always struggle to buy something in the defense space. It is always like, always running much ahead of the fundamentals. So that is the only limited problem which we face in the space. Otherwise, we love the space. It is a structural theme and will do well.
Sandeep, very quickly onto the metals pack. Do you have a view there? Do you have a preference in terms of stock or tilt in terms of segments within metals that you like?
So metals we definitely like, but problem with metal is that you cannot have a big allocation to it. So we try to play metal through proxies. So we try to play metal more through ancillaries where there is long inventories which will ultimately benefit, because that is a much safer bet than direct metals. Because in case of direct metal, what happens that even if you buy, let's say 2%, 3% of your total portfolio, and it goes up 50% also or 100% also, it doesn't give you a big delta. But if it goes down, a lot of panic happens, and generally, we don't want to have such high beta in our portfolio. So we always play metal with ancillaries. Although I believe that metal will have a good run because of the global situation we are in. Additionally, whenever rupee depreciates, then metal obviously benefits because of that also. So I think metal sector is a good one. We like the ones which have aluminium and silver exposures. we are not so keen right now on the ferrous side.
Okay, interesting. But Sandeep, so great having you on the show today. Thanks as always for your times.